Hello, world. Welcome to Harness Money. I am Colin, and this is my show. Are you a growth investor or a dividend investor? Which one of those options is better for you, meets your financial needs? That's what I want to explore today. Is it better to be a growth investor or a dividend investor? Because both sides of that coin have advantages and disadvantages that I want to explore, that I have been interested into. I've been one type of investor at one time, and then I've migrated to another type of investing at another time. And I want to break down which one is the right fit for you. So let's get into it. Hello, world. Colin here with Harness Money, and welcome to my show. Is it better to be a growth investor or a dividend investor? That is what I want to explore today because each of those different buckets has advantages and has disadvantages. I know that I've been drawn to dividends sometimes, and then I've been drawn to growth at sometimes. And I want you to ask yourself, which is better? Which is better for you, dividend investing or growth investing? Let's start with growth investing. What are the advantages of investing in growth? Now, when you invest in a growth company, I really consider this a smaller business that's growing more rapidly that don't pay dividends. Yes, there are some growth businesses that pay dividends, but I'm talking about those young and hungry companies that have a lot of future potential but haven't yet reached that potential. One of my favorites is GoDaddy. I talk about this all the time. I think GoDaddy is a great company. They have transformed over time, and I think they have a big future ahead of them. But they don't pay a dividend yet, and they're still really growing that revenue side of the business, that top line revenue. So they're not worth a whole heck of a lot right now. They're definitely over a $10 billion company, but they haven't reached the level of a 3M or an Apple or an Amazon or anything like that. So they still have a long runway to go before they reach that mountaintop. Now, it's true. The growth stocks have a lot of potential. So if you invest today in a growth stock, you get to reap the rewards 10 years from now or a decade from now of investing in this beast of a business while it was young, and you will be rewarded for that. But you have to hang on for a long time. You're going to have to go through many years of ups and downs before you really reach that mountaintop of a big valuation. But it can be lucrative. It can be really lucrative to invest in some of these younger, hungrier startup businesses and then ride that wave up to a high valuation. Now, there are some disadvantages to that. You have to think during that whole time that you're holding that business, you are not getting paid. You're not getting paid as an investor to hold that business. So you don't get any cash flow from that investment. And as well, it's a little bit of a risky bet. You're taking a flyer that this business is going to be a beast in 2 years, 5 years, or 10 years from now, which it may not. That may not pan out, and you could be holding that company for a very long time. I remember when Microsoft was a growth company, and then they kind of plateaued. They were a growth company for a really long time, and then for about a decade, their stock just kind of hovered around $50. It didn't go up, it didn't go down, but it just kind of held there and didn't move for a long time. So if you were a shareholder, yes, they paid a small dividend, you were getting paid a little bit, but that's not why people were investing in Microsoft. They were investing in Microsoft because they believed that it was a strong growth business. And for a long time, it didn't pan out that it was going to become a beast. It wasn't until more recently that it has reached new heights with their cloud business and that it took off. So you really had to believe in the company that it could be successful. Same with Amazon. That's the same story for Amazon. They went public during the dot-com boom when all the tech companies were going public back in the 2000s. And then, of course, that bubble burst, and it took a really long time for that company to get to the heights that it's at today. So you had to really believe in that mission and hold on to that stock through thick and thin to really reap the rewards. But that's part of growth investing. Now, the other piece to think about when you are investing into a growth stock is the withdrawal. Let's say you've invested for 20, 30 years and it's time for you to retire, that you have reaped the rewards of working at your job, starting a business, whatever, and it's time to withdraw that money. Well, you're going to have a lot of capital gains from the valuation increase in your stocks, and you're going to have to withdraw that money. You're going to have to sell off your stock in order to enjoy that cash, and you're going to have to pay taxes on that money, on those gains. So you really have to think about how do you want to withdraw versus the other side of the coin is if you are investing for dividends, you have that cash flow. You can rely on that cash flow and you have a little bit more flexibility of Social Security, dividend stocks, and maybe some other income that you're bringing in from a rental or from some other investment that you have made. So you might not have to sell off your equities doing dividend investing. But the potential for growth stocks is really enticing. These younger companies, you can get in young and you can really triple, 5 times, 10 times your money in the market if you choose a stock that is young and that does really well over time. And most of these growth stocks, not all of them, but a lot of them are in the technology sector. Right now, the NASDAQ has been hit hard in 2022. It's down over 10%, the NASDAQ, which is primarily the big tech stocks. And that hurts a lot when you see your dividend portfolio drop like that. But that's part of being a growth investor, is that there is more volatility in growth stocks because these companies haven't proven their revenue yet. They're still trying to grow that top line at a fast rate. So when the economy dips or when the Fed raises the interest rate, those stocks are going to be hit harder than some of those big boy dividend aristocrat stocks that are out there. So that is something to keep in mind. Well, that do you have the mental fortitude to stay the course, to continue being invested in these companies that you really believe in, because it's a long-term investment to really reap the rewards of being a growth investor. Some good things to think about that I've had to think about and wrestle with. Now, let's talk about the other side of the coin, which is those dividend stocks. Those dividend aristocrats are usually much larger businesses. They're the Coca-Colas, the JP Morgans, the 3M, Caterpillar, Johnson & Johnson. All of these businesses have been around for decades and they have a good amount of revenue that they are bringing in year after year, recurring revenue, and that they can choose to pay a dividend out of the profits that they make off of that revenue. That can be really enticing as well. Many people invest in those companies specifically for the cash flow because every single quarter, those businesses are going to pay out that dividend to their investors. And then over time, lots of those businesses even increase the amount of money that they are paying out as their revenue increases. Now, the problem with dividend investing is that a lot of those companies are slow growers. They've already gone through the growth phase. They've already reached the mountaintop of revenue and they're sitting on this fat stack of cash, but they're not growing as quickly now as they were in the last 20 years. Coca-Cola, Johnson & Johnson, Caterpillar, they may not be growing as fast as they did in the past, and that means that their stock may not appreciate in value as quickly. So you're kind of sacrificing a little bit of growth for that cash flow that you are receiving. So you really have to ask yourself, is that worth it? Is it worth it to receive cash for a lower level of growth? Now, this isn't always the case because there are plenty of companies out there that dramatically increase in price even though they pay a dividend, like Apple, Nvidia, Microsoft, some of the like JP Morgan, that stock has done really well. Home Depot, there's a lot of stocks out there that are both, that are still relative growth stocks, but also pay that handsome dividend. But by and large, if you look at the entire picture of all the dividend paying stocks, the dividend aristocrats, they grow a little bit slower than those younger, hungrier businesses, which is fine. That you're mainly not investing for the growth, you're investing for that cash flow, because that cash flow can do a lot for you. It can pay your bills, it can give you the dry powder that you need to put into more investing. So when you get paid dividends, you can then reinvest that money into buying more shares of either that dividend stock, or you can put the money into another growth stock and just accumulate more and more shares and get that compounding machine to work for you. This is what we're all going for, is that compounding effect that the stock market has on our portfolio balance. It is really a question that you must examine. And one of the best ways that I like to think of growth versus dividends is Berkshire Hathaway. Berkshire Hathaway is one of the most unique companies on the planet. Pretty much, it's one of the biggest businesses in America, and it's just one of the most unique businesses, because really all Berkshire is a holding company for lots of other businesses. I really break it up into two pieces. And this is kind of how I think of my own investment, is I like to do both. I like to invest a little bit in growth, and I like to invest a little bit in dividends. And I separate those portfolios out so I can see the different performance and how one is doing over the other, and in which type of accounts they are. But Berkshire is essentially, on one side, it's a portfolio of stocks. They have a stock portfolio that is very large, of just money that is invested into assets like oil companies, like big banks, like credit card companies. All those businesses are part of the portfolio. Then they have the other side of the businesses, which actually holds big businesses that produce cash flow. They wholly own other companies like BNSF, or Dairy Queen, or Nebraska Furniture Mart. These are all brands that are under the umbrella of Berkshire Hathaway. And I like to think of it as growth and cash flow as well. So the businesses that they own provide the cash needed to invest into those stocks, into their portfolio. And a lot of those stocks in the portfolio also pay dividends. So they're also producing cash. But the irony is here that while both the stocks and the businesses are producing cash flow into Berkshire Hathaway, that business does not pay a dividend. They don't pay out any of the money to those shareholders. So that leads me to believe that this business is really investing for growth. That means that they have to do two things with their money. They either have to buy three things. They can hold the money in a bank account, which is generally what they have done in the past. They can then go out and buy other businesses, which they've done just recently with an insurance company, or they can repurchase their own shares. And that is all in an effort to build up that company bigger. So this company is always in growth mode. Even though they've reached this huge amount in market cap, they are still looking at themselves like a growth business. Like, how can we dramatically increase our revenue and the number of holdings that we have in our portfolio? So it's a good illustration of the differences between cash flow and growth. Most companies are not like that. They are in one lane. They're the Johnson & Johnson, which focuses on healthcare, focuses on vaccine and consumer goods that are in the healthcare space. Same with an oil company like ExxonMobil. Their mission is pretty much to extract and sell oil and make a profit off that. They don't hold all these other businesses under their umbrella. So what I would recommend to anybody is to begin with the end in mind. Think about what type of investor you want to be and where you want to be in 30 years from now. Because That is where your mind is going to draw or is going to go more often, is if you set that goal in your mind that you want to have a portfolio balance of $1 million, and you're fine with slowly selling off your stock at the end to fund your lifestyle? Or would you rather be the person that accumulates shares, and instead of having a $1 million portfolio, you receive, let's just say, $10,000 a month in passive income? That whatever investments you have, whether it be stocks or real estate or another side business, you want that business or those assets to pay you money each and every month. That is your end goal. And that's how you need to determine if you're going to invest in growth or invest in dividends. Also, you want to think of where you are investing this money, because that makes a difference as well. If you're investing in a health savings account or a Roth IRA or a just taxable brokerage account at like Robinhood or Public or wherever, that makes a difference too. Because if you're investing in a Roth account, then that means you're not going to pay taxes on the gains that you receive from your investments. Same with a health savings account. If you're putting money into those investments in those accounts, then you don't have to pay tax on that money if you spend it on health related costs. So that may change how you are investing. You may want to receive more dividends in your Roth because it's tax free versus dividends in your taxable brokerage account, because you're going to have to pay taxes on the money that comes off of those dividends. Now, it's not as much as ordinary income, your dividend income, but it's still money that you're going to have to give to Uncle Sam if you receive payments from those companies. Or you might not care. You might tell yourself that is the cost of investing, is paying your tax on the money that you receive. So really think about where you're putting that money. Think about how you're going to withdraw that money at the end, or what is right for your lifestyle, and then make your investment decisions off of that. Like I said, I personally have both dividend and growth. In my Roth, I have more dividend stocks. In my taxable brokerage, I have more growth stocks that are younger, hungrier. The Honest Company, Dutch Bros, GoDaddy, Restoration Hardware. Some of those are stocks that work for me. I'm not saying this should work for you. I'm just saying this is what works for me. And it's much more volatile putting money into the taxable brokerage account, because those are younger, less established companies than some of the dividend companies like JP Morgan or Waste Management or Home Depot. Those companies, those are some that I have in the Roth. So really think about it. And you know what? You might also look at which one is doing better. So building a portfolio of each, and then maybe taking 5 years to see which one is outperforming the other. But you're really not going to know in the short term. It's really going to be a longer term experiment that you run. So thank you for watching this video. I hope you got something out of it. And remember, make good money choices. Till next time.